Hi, everyone. I'm joined by my friend Eric Green, who is an attorney specializing in taxpayer representation. He's got an office in Connecticut and New York and works with clients all over the country. I've referred his firm tons of clients that need help with representation in front of the IRS, state collection agencies. I believe you guys do audit representation, offering compromise, and it's awesome. I've had great, amazing results. I worked with Eric for probably a decade now. Now, one really cool thing that you want to know about Eric is the co-founder of the Tax Rep Network, which is a professional association I belong to, mostly so I can learn. I don't do a lot of tax representation myself, probably just my VIP type clients. But one of the greatest things that I've learned from the Tax Rep Network is, what are the best practices on how to deal with IRS, how to deal with state agencies, and as a professional, what is my role helping my client through this process. And Eric, I want to share one of my favorite resources from the Tax Rep Network, which is this IRS state tax collection document checklist. This is a 3-page checklist. Pretty much anytime a taxpayer comes to me and says, "Hey, I need help with the IRS, I need help with the state agency, can you help me?" And really, it could take a 2-hour conversation to dig into what the issue is, where the taxpayer stands, all that stuff. I just send them this checklist. And if they provide the full set of documents from this checklist, I can spend maybe 30 minutes and get a really good assessment looking at all the documents. And if the taxpayer doesn't send me a checklist, then I'm not gonna waste my time working with them. So I'm gonna make this checklist available. Eric, I believe you said that it was okay. It's not a public document, but I'm gonna put it in the description. It's a 3-page document. Basically, if you yourself are a small business owner, and you're going to deal with IRS, deal with a state collection agency, this is a good starting point on what you need to have, because this is the stuff that they're going to ask for and the stuff they're going to look at. So you need to be prepared with these documents. And if you're a tax professional or a bookkeeper and you have a client that's dealing with an IRS collection, an audit, and some sort of enforcement, you want to make sure that all these documents are there to compiled to pretty much get started. So Eric, that's the introduction I have given you. Did I miss anything?
No. And we created that checklist for the very same reason. We would sit and go manually, do you have this, do you have that? And as part of just being more profitable, more automated, when you contact us, we send you out the agreement for the consult. We send you the link to pay for the consult. A link will go with this, as well as a place to electronically upload all of your documents. And I think we've cut 30 to 45 minutes off, and we open 15 to 20 cases a week. So, I mean, you start adding that up. I mean, if we can save 10 hours of staff time, that's huge.
Absolutely. Awesome. So, okay, so we'll make that available for you guys, but let's get into the meat and potatoes of this video that we wanted to put together, which is, Eric, one of my favorite webinars that you taught is called, I believe, Top 8 Tax Season Mistakes. And these are really important pieces of information for you to know if you're a taxpayer, an accountant, a bookkeeper, a tax professional. You want to know these things because these are like sort of the gotchas. And also, a lot of my clients come to me and say, "Hector, tell me about the red flags," or "Is XYZ a red flag?" And they talk about a red flag a lot. And red flag is really not a real concept. It's more of a construct. But the things that will trigger a verification because there's an error, right? Or sometimes it's an obvious error, sometimes it's a computer calculated error. Those things are really important to know. They're not necessarily flags per se, but there are things that do not allow the return to be processed automatically. And it's more likely to trigger someone having to look at it manually or having to send it to enforcements or collections or audits or whatever. So we want to talk about those. And so Eric, go ahead and share your screen, and then maybe I'll sort of pick your brain about them. I know that the webinar where you actually teach this in the Tax Rep Network, it's actually a series of webinars, but I think you have a 1-hour webinar, and this video will be to summarize this. So if you love this content, then I want you to look in the description, click on that. It's a free webinar. I believe it's sponsored by Intuit.
So Hector, I have to tell you, so we were approached by Intuit about starting to, they are, I think, beginning to see more and more in the advisory area in terms of services. And so we're doing 2 1-hour webinars with Intuit this month, one on offers and compromise, and one on the top 8 tax season, mistakes. And these are the mistakes that we see trigger the IRS enforcement. So in my office, people come in and we're looking through things. And I'm like, ooh, that's what did it, right? Or, gee, if you'd only stopped and done this. So it's always good, I think, if we can let the professionals know, here are the things that we see that go wrong. And if you can head this off at the pass, much more likely your client's not going to end up with a problem.
Awesome. Okay, let's jump right to it. So what's the number one top?
All right. I call this common mistakes. And this is what I'm talking about. They're being audited. Why? They claimed all 3 children, but one of them is 20 and filed their own return, right? Or there are typos, social security numbers that are screwed up. All of that kind of stuff. And again, you think that this, especially if people come year to year, it would get carried over in the software. But very often you have new folks come in, their return may be wrong from before. It's input incorrectly. So we don't want to spend much time on this, but we do see a bunch of this. The lesson here is, especially if it's a new client, make sure you get real source documents. Don't just rely on last year's return, because frankly, my partner loves to say, how do we know that preparer wasn't insane? Who did the return last time? So, you just want to be kind of careful with that.
Yeah, that's a good point. As tax preparers, we assume the last tax return is accurate, and we follow suit, and we've taken somebody else's problem, the previous preparer, and we made it ours by filing with the same exact information.
Have you ever had this where the person gives you the return, you look at the return, it just looks weird, and you're like, hey, you have so-and-so, and they're like, no, I don't have that. Well, you claimed you had a Schedule C loss. I don't know, I have a W-2 job. And now you begin to realize there's fraud on behalf of the former preparer. And we see a lot of this. And so say, well, who prepared this? My cousin. So now we don't want to throw the cousin under the bus, but we got problems there.
So if you're a small business owner, not a tax preparer, most tax preparers know and understand this, but if you're a business owner, the lesson here is double check the name, the middle name, double check the date of birth, double check your dependents, the social security numbers, make sure that you don't have, if you have dependents that are not children, make sure they're put in the correct category per se, in terms of the type of deduction or tax credit you get for that. So that's just due diligence, go through all the documents, make sure that nothing that you as a taxpayer understand to be wrong. Names, addresses, social securities, date of births. Okay, good. Next one.
All right, preparer considerations. Hector, what is our job? If we're, and I don't prepare returns for a living. I'm like the food critic. I couldn't cook the meal, but I love to come in afterward and give you my opinion on it. So, if you're a tax preparer, what is your job, right? What are your duties? Under Circular 230, which are the regulations that kind of oversee anyone practicing before the IRS, we are not required to audit the client. All right, you don't have to audit your client. You don't have to see every scrap of paper. However, you can't turn a blind eye to obvious flags. And I'll give you my favorite one is the client that comes in with every single expense a nice even number, 1,000, 1,500, 2,500. What are the odds on that happening? Better yet, do you think the IRS knows how slim the odds are on that happening? Those are clearly estimates. Or the person that comes in claiming they make $12,000 in income as a waiter or waitress or wait staff. And you'd say, I love to play dumb. Say, okay, you're married, 1 child, congratulations. Apartment, okay, how much is the apartment rent? Okay, utilities, are they included? No, okay. And I start doing some quick math. I'm like, so you're spending at least $5,000 a month. That's $60,000 a year. You're telling me you're making $12,000. How are you living? Now, Hector, they could say, well, my parents are loaning us money. My wife's going to school. Perfectly fine. You're right. I can document in the file. Client explain they're getting help from the parents. Right? Or you might hear, which I hear, how are you living? And they'll say, well, you don't think I report all my income, do you? That's a problem. Okay. So when it comes to our considerations, what we need to be looking at is you don't have to audit the client. All right. Easy. No, you don't have to audit them, but you can't turn a blind eye to things that should be obvious, that would raise an obvious question.
Yeah, one of the things I get this question a lot, and these are clients are no longer clients of mine for obvious reasons, but they say, what is the minimum I need to report to avoid a red flag? And that's yeah, that question is such a bad question in the first place, and it would be irresponsible of me as a CPA to even entertain an answer. But not necessarily an answer to that question, but just some logic to apply is, look, in accounting, there's debits and credits. A lot of people in the IRS, they're accountants. They understand, the concept of debits or credits. You take a look at how much your lifestyle costs, the stuff that's visible, right? Your car, your house, your utilities, food for the house, your private school if the kids are in private school, all the stuff that's pretty obviously known and understood about the taxpayer's lifestyle. And you multiply that times, whatever, monthly, annually. And if you are not at least making that income, that money's coming from two possible places, or actually three possible places. It's coming from saving. So, quote, I'm living off of savings. So then you would have had the difference between what you made and what you spent in cash at the beginning of the year and not anymore. And that stuff can be proven. You can look at bank accounts and see, did I have the cash somewhere and did I live off that? So that's the debit and credit portion. That's the accounting portion. The second source where you can, earn from, I guess it would be from debt. So you would have to have, considerate amount of debt at the end of this year that you took on in order to pay for your lifestyle because you didn't make it on tax return, right? You didn't make it on income. And the third one would be, like you said, gift. I'm living off my parents, but there's also a limit to how much gifts you can receive or how much gift they can give, which is, I think it's like $15,000 a year per taxpayer. So there'll also be sort of a limit on how much, you could say that you got as a gift until it triggers gift tax anyway. So right. In essence, as a tax preparer, I do not audit the client, but there's a threshold of nonsense, so, and again, if it's not super obvious, it's within the consideration of possibilities. And I tell the client, look, just give me the information, make it truthful, and I'm okay with it. But I think as a tax preparer, if it smells like BS, I have to call it out. And if the taxpayer, can minimally not prove, but minimally have an explanation that falls into one of those categories, living off, savings or living off gifts or taking on debt, then I would probably be comfortable with something like that. But beyond that, I would have to say, look, if it's nonsensical, the IRS can also see that pretty easily, pretty clearly.
The government uses something called a cash T, right? Literally, like a T account. And everything on the left are all the known sources of cash into the household: borrowing, gift, wages, net income, whatever, savings, right? That you had the cash that was in. On the right is all the cash we know you spent going out. If the right exceeds the left, that has, and it's held up in court, that is a firm indicator of unreported income, right? So yeah, no, absolutely. I mean, again, I don't counsel people this way, but an easy starting point is if the IRS showed up and calculated what you spent, can you explain where it came from?
Yeah, and I think if you're self-employed, industry matters too. So if you're like you said, waiter, like waiters, they get cash tips. And a lot of restaurants don't do the due diligence to report those tips correctly, or at least do the minimums. Or if you own a food truck, are you like if you're in the industry that typically deals a lot with cash, IRS will know that, and I guess it contributes to again, not a red flag, but it contributes to the probability that they can say, hey, something smells weird here.
If you are in a cash intensive business, that in and of itself is a red flag, because the IRS comes into that audit knowing that there's a chance of unreported income, and they're going to be looking for that.
Okay, so the third one is non-cash contributions. What is that?
So I donated, right? I donated a piece of property. I donated a piece of art. I donated a car, right? We have cars for Cars for Kids up here is a big charity. You donate the car, they end up selling it for parts or whatever, and it all goes to this children's charity up here in the Northeast. If you're going to donate, and unfortunately for most of the tax preparers, you learn about this during tax season, not when they did it. The taxpayer, if they do a non-cash contribution of $500 or more, they are supposed to have a qualified appraisal. And that qualified appraisal has to be done at the time that they do the donation. So I've had this where a taxpayer donated a piece of art. The museum that they donated it to gave them a letter. Thank you for the original blah, blah, blah. We believe it's worth $185,000. That's not a qualified appraisal. So they got audited. The auditor said, "Where's your qualified appraisal?" They didn't have one. They only had this letter from the museum. They actually denied them the deduction. We ended up litigating and settling the matter, right? But the client spent $25,000 in litigation on it. So when it comes to a non-cash contribution, $500 or more, there must be a qualified appraisal that is attached to the return when it's filed. But as a general practice, like we're cleaning out an apartment right now for my in-laws. We're donating a lot to like Goodwill. We're not taking any deductions for that. Zero. It's not worth inviting in the auditor to start fighting with us over what my old suits that don't fit anymore, right? What those are worth, right? You're only supposed to get thrift value anyway. They're selling them for $10. It's not even worth it. I don't even take those deductions. But just do know if it's $500 or more, have to have a qualified appraisal, has to be attached to the return.
Eric, if I have a piece of art that I paid $100 for 20 years ago, and now it's worth, let's say, 100,000, okay?
Yep.
And I want to contribute that and take that as a deduction. That's where you need an actual appraisal, right? That's what you're saying.
Yep.
Now,
Yep.
is there a capital gain? Like, do I pay tax because that went up in value, or no, because it was donated?
No, because it was donated. In fact, one of the great ways around the IRA, what we do with some of, and this is over on the other side of the floor. If you're with me and Jeff, you probably have tax problems. On the other side of the floor with Mark Sklarz, Jay Marsh, and Kristen Lynn, our partners, they're doing planning for a lot of our high-end folks. If they want to do charitable giving, IRAs are a great way to do it because you avoid the income tax. You get the deduction for the charitable, and you don't have the income tax that you would have done picking up the IRAs. You took money out,
Wait,
your requirement.
hang on a second. This I didn't know. I'm learning something new. So let's say, for example, I've put money in my IRA. 401k same or it needs to be an IRA?
Well, because you have to be able to donate. So let's say it's your IRA.
Okay,
right?
IRA, okay.
And Hector, you have done phenomenally well, and you and your family want to leave a legacy to your church, your synagogue, whatever. A great way to do that is to actually donate from the IRA. Because if you think about it, if you draw from the IRA, right, you have to pick up the income, the required minimum distributions. You're probably in a lower tax bracket, probably when you retire. So there's some savings there. To avoid the income tax completely, if you're going to donate, do it from the qualified money.
Is there a limit per year on that? Is there a limit?
I don't think so.
My instincts tell me there might be a limit, but I guess
you
we'll
know
research.
Well, I have to get Kristen to join us for one of these and have her walk us through how that works. But anyway.
Long story short, if you're going to donate money, you have two options. You can either donate it and possibly take it as a deduction. And I don't want to get nerdy into the mechanics of how tax works, but many times, especially lower income taxpayers, they really cannot deduct those contributions because the standard deduction is higher anyway. So a lot of people that make, let's say, under 50 grand a year and they give 20%, right, which is $10,000 a year to the church, the standard deduction is probably better anyway. So they end up really taking zero tax benefit from that. So if you're in a situation where the contributions to a nonprofit, a qualified contribution, doesn't give you the benefit as a deduction, and you have an IRA, might as well pay it from the IRA instead of paying it from your after tax money. That's what you're saying.
Yeah, if you're somebody who's retired and you want to do make a donation, if you can do it from the IRA, you avoid the income tax, right? You still get the charitable deduction. So,
But if you take it before you turn 59 and a half or whatever, you still have to pay the 10% for like it needs to be after that age.
you know what? I've never had a client do it. I'd have to research it.
Okay,
I'm
all right.
wondering if you have to pick up. Probably.
I'll find those and I'll put it I'll put a link in the description to that.
All right.
I find that part is fascinating and even occurred to me to make contributions from the IRA. Okay, let's move on. The video is getting too long, Eric. It's my fault though.
All right.
Hobby losses.
Well, we're not gonna spend time on this. If you have a client who has losses year after year, Schedule C, Schedule E, it can trigger the hobby loss rules under Code Section 183, which limits the losses. If it's not really for profit, but it's a hobby, the losses are limited to the amount of income. So effectively the losses get suspended. There are 9 factors that the IRS looks at. If you have a client that you have losses year after year, I think what you do is put the brakes on, extend them. And during the summer, you're going to spend some time going through the 9 factors with them under 183, because you may be able to help the client, right? Are they running it like a business? Do they have a separate entity? Do they have a separate bank account, books and records? Are they marketing? Can they prove that they're trying to advertise and generate money for this? There are all these, these factors. Just the key thing to know during tax season is don't just knee-jerk file and assume they're going to get the loss. If they have losses for more than 2 years in a row, and this is like the 3rd year, that may trigger an audit by the IRS under the hobby loss rules.
Right. It means if 3 years out of 5 have losses, right, which means the majority of the 5 years you spend losing money rather than making money. It's not a business, it's a hobby. And the IRS can say, hey, you know what? We could go back and audit you 3 years. And if there's a significant, deficiency in tax liability, they can go all the way to 6 years and go back and say, you know what? This business that you've had for the last 6 years, that you've taken a loss every single year, it turns out it's not a business, it's a hobby. And then they'll reverse back all those losses, put them back as income. And now you have to pay income tax as if you never had the loss in the first place.
It can also impact a lot of other things. If you took medical deductions based on your income and your income suddenly goes up, you can lose some of those deductions. There's an impact across the board. So there's a presumption if you have losses in 3 out of those 5 years that it's a hobby, but you can get over that, right? You just need to be able to document that it's really a business. That's where you can play a constructive role.
Do you have any document? Did you have those 9 test factors? Do you have a document on that we can share, or maybe send me a link later? I'll put in the description.
I do. I mean, we're going to be doing it on the Intuit program that we're, and it's free this month.
On the free webinar. Okay, cool.
Yeah, but yeah, no, absolutely. So innocent spouse, what innocent spouse is where if taxpayers will file a joint return and there's a liability, and now the spouse believes that they shouldn't be responsible. Okay. So how is this a tax season mistake? There is a sort of a knee-jerk default that most accountants do, where if you're married, filing joint, right? It's sort of an automatic. What I would advise, there are 2 situations where you do not want to do that. Number one, if you know the couple is getting divorced, right? Hector, if you called me and said, look, I have this taxpayer, she's in the middle of, they're filing for divorce, I got to get their returns done. What do you suggest? Married filing separate. Okay. Why? Because, they'll go do married filing joint, and in their divorce agreement, it'll say something like the husband agrees he's responsible. And I'll have the wife or the former wife say to me, but I have an agreement that says, and I'm going to tell her the IRS doesn't care. Well, not they don't care. It's a factor they'll look at. But there's a federal statute that if you file a joint return, you are jointly liable for that debt. Now, here's the thing. Can you just each year decide married filing joint or married filing separate? Yes. Understand something. The default status for all taxpayers is married filing separate. You elect to go joint. Once you elect to go joint, You cannot amend to go separate. You're stuck unless you get innocent spouse relief. So the rule should be, if there's going to be balances due with the returns, or there's something funny like a divorce or something else going on, my advice is, and you know what, Hector, this always comes up where I'll get the CPA or the EA that will call me. It's October 15th. They just got the return done. There's going to be a big balance. They don't know what to do. There's no time to figure out if they can do an offer. What, so Eric, what do I do? It's easy. Married filing separate. All right. And after tax season is over and you've had a cocktail and you've taken a few days off, you can get the clients back together and go through the analysis with them. If you determine they're better off joint, you can always amend to go joint. But if you married filing separate, at least you haven't dragged the other person into this. Because I will tell you, as someone who does these cases, inevitably, the issue is raised. Eric, Hector did this. He filed this joint. Can I sue him? Shouldn't he have stopped and thought this through? And I'm like, I really don't want to go there. But the truth of the matter is, if you, especially with so many non-filers, Hector, the IRS is going after 10 million non-filers right now. These non-filers, when they come in, they're always like, hurry up, hurry up, hurry up. We got to get the returns done. You got to think this through. If there are going to be big balances, you have to think about what collection looks like. If you're up against a deadline, married filing separate, you can always amend later to go joint. And the big question I always get about this, Eric, we've always done joint. Won't it be weird that now we do separate? No. Your default status is separate. You've been electing to go joint. You can actually change every other year if you want.
Okay. So just hold on. There's a lot of information here. So
okay,
you can do 1 year joint, 1 year separate, 1 year joint. That doesn't raise that's not a red flag. That's totally okay. The challenge would be is if you file joint and one of the spouses, whether it's the husband or the wife, is technically not making any money or not responsible for the tax liability because it's generated solely by the activities of the other spouse. And post-divorce typically is when the spouse that wasn't making the money or wasn't responsible, they don't want that tax liability to fall on them because it doesn't split half and half. It's not like you get divorced and the tax liability is, well, half yours, half yours. Both of you are responsible for the entire amount. The innocent spouse is a process where a spouse that didn't know or was not involved with making that money, and for several years, the taxpayer, kept having a tax liability and not paying for it. Even post-divorce, that spouse that had nothing to do with making that money, it's still 100% responsible for that liability, the same way that the ex-husband or ex-wife is. So there's a process to basically relieve that spouse, but it's a really expensive and long, and they have to accept it. It's an entire case. So what you're saying in summary is, if you know that the divorce is imminent, right, and these two parties are not doing good financially or they're not doing good with each other, don't save the $10,000 or whatever, to do it joint, then cause even a bigger problem. Default to separate, even if the tax liability as a sum for that year is higher, because you will be doing that spouse a favor, correct?
Yeah, well, and I'll give you an example. Husband and wife come in. I'll use myself. My house isn't in my name; it's in my wife's name, right? I'm an attorney. I've never had a malpractice claim in 22 years, but look, everybody makes a mistake. Who knows? Why would I want to file a joint return if I'm going to end up with a balance and drag my wife, our house, her 401k, because she's a professor, drag all that into this? Now, the problem, again, Hector, you're sitting there, it's October 15th, and now you got to figure this out. You don't have enough time. Married filing separate, right? And then later you sit down, you go through an offer and compromise analysis, what we call RCP, and you determine, you know what, they'd be collectible if we had dragged the spouse in, leave it alone, married filing separate. If on the other hand, they're going to just pay this, right? I mean, yeah, they'll need some time, but they're going to pay it, and you can limit it by joint, then you could always amend to go joint if it's in their best interest. does understand you can amend to go joint. Once you file joint, you cannot amend to become separate. You've made the election, you're stuck. So when push comes to shove, default to the separate. You can always fix it later to go joint. You cannot do it in reverse.
Yeah, I can totally picture how one spouse has had a job, a 401k, a pension. One of the spouses has built wealth the old traditional way, and the other spouse is an entrepreneur, always hustling and bustling. They make all the money, but that's all the money that is spent in the lifestyle of both spouses in the first place. And the only one really accumulating wealth over time is the one that has the regular job. And in the event of a divorce, this unfair situation happens where this tax liability is now being paid with the wealth built by the spouse that wasn't the one kind of like causing the tax liability in the first place. Okay, so the next one is balance due. What's the deal with this one?
Which honestly, we've already covered. I generally do these two together. Same thing, right? I mean, if there's going to be a balance due, think through before you just file. For instance, married filing joint, married filing separate, we talked about. And I've had this, Hector, I have folks who are in like the banking industry, or they are in they're like a real estate developer, they have lines of credit. A notice of federal tax lien will be devastating to them. So I get this a lot. We're going to file 2 or 3 years with these balances due. Is there any way to avoid enforcement? And normally if they're successful, can you pay this given enough time? Yes. Here's what we're going to do, Hector. Instead of getting all the returns done and getting them all filed, we're going to file them and pay one at a time. 2 weeks later, I'm going to file and pay the next one. And we feed them in one at a time with the payments. Bills will come out with penalty and interest. They're paying that. I've literally brought people in and settled 1.2 million of debt and never had a notice of federal tax lien filed against them.
But Eric, one thing I think is important to mention though, if you are going to go into an offer and compromise or do some sort of negotiation,
yeah,
I think at that point you have to do all your returns. And
I mean, at that point, you can't stop the lien either.
Right. Okay.
Right.
Yeah.
But where if you have a client that comes in and you prepare now back, 3-4 years of returns, and the lien, I have a case coming in tomorrow. It's on this exact same situation. The lien for them will be devastating to their business. Is there a way to feed the returns in with those balances due and take care of them one at a time so that there's never any outstanding assessment that would trigger the automation of the filing of the notice of lien? Is really what we're getting at. But yeah, no, to do an offer or to wrap the thing up as a payment plan, all the returns have to be in. You're right.
Good point. Okay, so we got 2 more, right? Let's quickly go through them.
And listen, earned income tax credit. I have defended more accountants, EAs and CPAs in front of OPR than you can imagine. It's actually a pretty decent part of my practice. When it comes to the earned income tax credit, you have to do the following, right? You're supposed to do the checklist. You're supposed to have the documents for the dependents, right? And you're supposed to make sure that all of your staff, if you have staff, have been trained. You know where people get in trouble? Auditors come in, you're doing a lot of EITC work. If they notice that you can't prove that you've trained your staff, or you don't have the backup documents, because year by year, it's the same kids, right? They've actually gone after the preparer. I've had one as high as $125,000 in preparer penalties they went after. So here, if you do EITC, here's what you got to do. It's January. Your staff have to prove they went through a course on EITC. The fact that you told them to go to the IRS system and IRS website and watch their video, not good enough. Not if you have to defend this, it's not going to be. I would require them to go to an Intuit. I think Intuit may have a course, or somebody that has a course, and they have to get you, the owner of the practice, a certificate. So if the auditor shows up, say, yeah, you got 3 staff preparers here. Are they trained in EITC? You can say, yes. As a matter of fact, they have to take a review class. Here are the certificates. You just took that issue off the table. You've done the checklist. Most software has the checklist in the software. That's fine. Let's say it's the same 2 kids year after year. the backup, right? The birth certificates or whatever you have, make sure it is in the current file. Where it's not, they have gone after the preparer. And the preparer says, well, but I have it. It's in the prior file. You're supposed to have it when you do that return. And they are, I don't want to swear, they're really strict about this. So each year for those EITC clients, make copies of that backup, or if you have it all electronically scanned, make sure it's in the current year's backup. Make sure that the checklists are done, and make sure your staff are trained and you can prove that they've got the updated training. If you do that, you should not have a problem. If you don't, you're going to have a very expensive problem.
And for some context for those non-tax preparers that are like, what the heck he's just talking about, the earned income tax credit is it's a tax credit that reduces your tax liability effectively, that only really applies for the most part to low income parents. So if you make under $80,000 a year, I forget what the number is, maybe $60,000 a year, and you have kids, there's basically a formula that gives you a credit that reduces the tax liability. And a lot of parents that make, $60,000 a year or so, it's pretty transparent for them. Tax preparer puts it in there, tax software puts it in there. But the point is that if you're an accountant and your tax practice heavily does this, you are taking a lot of government money and giving it back to taxpayers, whether it's through refunds or through a reduction of liability. And most of the fraud that happens that's tax preparer related, tax preparer fraud, and there's quite a bit of it. Some in Miami, some in New York, some in LA, biggest cities, obviously it's the biggest source of them, happens because people lie about who's their kid, who's their dependent, who takes care of them and that sort of thing. And that's what you mean. The checklist itself guides you, and most tax software has it, guides the accountant to making sure they verify, okay, are these their dependents? Are these their kids? Do they live with them? That sort of thing. So that's what it is. It's a tax credit, mostly the biggest bulk of it is for lower income parents. And as a tax preparer, you need to make sure that you're doing minimum due diligence. And if you do a lot of them, you're exposed. Okay, so that was just some context for people that are not in the preparation business. Okay, let's bring it home with foreign forms. What about foreign forms?
The biggest thing is you need to talk to the client about, do they have anything international, but also, Hector, have they received anything from overseas? I'll give you an example. One of the biggest issues we're having is I have a client, they inherited money, right? They inherited $1 million. There's no income tax on that. And this person was a stay-at-home parent, so that they didn't even file a return. They didn't have to. There is a 3520A penalty if you receive an inheritance from overseas and do not report it. The penalty is 35%, $350,000 penalty for not filing an information return, and there's no income tax due.
Is that 100? What was the threshold? 100,000 or 500,000? It's one of those two.
I have to. I think it's larger than 100,000.
I'll find it and I'll put a link in the description.
Yeah. So and $10,000 for failing to file the 5471s if you have an interest in a corporation overseas. Things that generally, in and of themselves, don't generate income tax. Like there's no tax on these. It's the penalties for failing, and often the tax preparer isn't aware of it because most people don't think to tell them. Yeah, I inherited some money this year from my mom in Argentina, right? There's no tax due. And Hector, what we hear a lot of is, I talked to the accountant. They said, oh, yeah, you inherited? Yeah, you don't owe tax on that. Nobody thought that there was a form that needed to be filed. So if you deal, especially with an immigrant community, like up here, we have a large Latino population in Connecticut, a large Polish population, where they have family overseas, they go back and forth. There's money that moves back and forth legitimately. This is a real problem because these don't necessarily generate, there's no income tax filing, but the penalties on these foreign forms are huge. So if you're a business person and you have any of this, please make sure you talk it through with your preparer. And if they don't really know international, get a referral to somebody who does. All right. We have a handful of CPAs and EAs up here who do nothing but international in Connecticut. I'm sure there are in Miami as well. People that, especially in Miami, it's such an international city. There are accountants there that know this like the back of their hand. It is worth the consult. If you are a preparer, make sure you ask about any foreign anything, transfers, business dealings, entities owned, investments, even if there's no income tax, because the downside on this, the penalties here are huge. I'll give you an example. Again, it's capped at 100,000, but a Form 926, Hector, which is where I transfer money. I set up an LLC, or let's say I set up, excuse me, not an LLC, and that's a corporation. I set up a corporation. I had a client set up a corporation in the Bahamas to actually import marble for their construction company. It just seemed like a good business plan to do. Transferred $1 million in, $100,000 penalty just for failing to file this Form 926.
So yeah, with foreign in general, like, as a preparer that deals with a lot of international, in general, if you're a US based taxpayer, and you don't have to be a US citizen, you could just be a resident that has either cash outside the country, okay, there might be a requirement for you to, even if there's no income, even if there's no interest being made, to just disclose those accounts. If you own a percentage of a company or a partnership in a foreign country, even if it doesn't generate any money or it's at a loss, there are requirements, disclosure requirements like 5471 and 5472, that sort of thing. If you own a business that has foreign owners of that business, and there's interactions between the business and those foreign owners, or between the US business and an overseas business that is owned by those foreign owners, there's also this disclosure requirement. So anytime there's foreign involved, most of the times it's not the income tax that gets you, it's the lack of disclosure in filing these forms that get you with penalties. All right, so Eric, we wanted to keep this video way under an hour, and it wasn't. I could talk to you for hours. I always enjoy learning from you.
You're my cigar buddy.
Yes, yeah, we're ex-cigar buddies. For the time being, I'm not smoking because of my voice surgery, but I have them there. I'm keeping them for a very special occasion, the ones that you sent me for Christmas. Thank you for that. Your email's in the slides. Eric's not going to answer your tax questions via email, but if you're interested, I guess, on joining any of the webinars or the programs, you can email him. If you want to join the Tax Rep Network, I'm a member of that program. You can email him. We can send you information about that. And specifically pertaining to this video, the follow-up webinar, I think it's in a couple of weeks, top 8 tax season mistakes. You're going to go more in depth. I'm going to put a link to that free webinar in the description. And I think the second webinar that you're promoting is to deal with collections, right? The collections webinar.
Offers and compromise.
Offers and compromise, really. That means you negotiate your tax debt with the IRS. That's basically what it means. Okay, so I'll put a link to both of those free webinars in the description. I'll put a link to the document checklist that we talked about at the very beginning. And then any other things that we basically said, are you sure what the threshold is? I'll put a link in the description to that as well. Eric, thank you so much. Maybe we'll see you in a couple months and talk about other things.
Absolutely. Bye. Thank you for having me.